Welcome back to another edition of The Talking Hedge. I'm Josh Kincaid, and this is a cannabis business podcast. Some interesting news this week out of Maryland. We have a company claiming that CBD has been trademarked. We'll get more into that story in a minute. Yesterday, Aurora Cannabis reported earnings. And this week, more to come is Canopy Growth, as well as the Supreme Cannabis Company, InMed Pharmaceuticals, and Neptune Wellness Solutions, all reporting earnings coming up. In the meantime, Canatech holds a medical cannabis conference in Panama, and the National Cannabis Industry Association, or NCIA, is holding a seed to sale show in Boston. The U.S. House Financial Services Committee is going to hold a hearing February 13th at 2 o'clock entitled Challenges and Solutions, Access to Banking Services and Cannabis-Related Businesses. So let's just kind of dive right into banking, why that's a problem, what the limitations are, and what the results have been. I mentioned at the beginning of the podcast that this is Cannabis Pot Earnings. Canada's two biggest cannabis companies report earnings this week, giving us the first glimpse of what recreational sales look like. Aurora Cannabis reports earnings yesterday. Canopy Growth reports Thursday. It won't tell us much about the normalized legal sales we'll look at, but there's plenty of headwinds in the first quarter, which will undoubtedly impact results. It'll help investors gain a window on how overall Canadian adult use market is progressing, as well as the relative ability for LPs to execute and gain market share early on. Canada legalized cannabis on October 17th. The rollout was not uniform across the country, so this week should give some much needed clarity on whether the supply chain problems have caused the shortages, whether or not they're going to be resolved, and whether sales are picking up in the current quarter. It's also going to be interesting to hear what they have to say about the plans for the U.S. market and how the hemp-derived CBD is legal. Canopy has already said that it intends to spend as much as $150 million to build a hemp industrial park in New York, but they haven't given any details on that. Last week, we reported that more millennials were buying cannabis stocks than Apple stocks. This week, we're seeing that there's an ETF that exceeded the $1 billion mark. That's ETFMG Alternative Harvest. And yet within that index, almost 20% is in one cannabis stock, which is almost the antithesis of an index. Rather than buying an individual security, you buy a portfolio or an index that gives you a lot of diversity, so that if one goes down, the whole portfolio doesn't go down, and yet $1 out of $5 is being bought on one company. So it's a huge, lopsided, potential messy issue. Alternative Harvest's top 5 stock holdings are Cronos, with almost $3.5 billion and almost 20% of their holdings. Less than 9% goes to Canopy with almost $16 billion, then Aurora at $7.5 billion, 7.7%, 5.5% for Tilray, that's over $7 billion, and then Organigram Holdings, 4.4% for $700 million. So at first glance, the weighing scheme looks pretty odd. Most ETFs use a system that's based on market cap or market capitalization that gives the largest companies the highest weightings. So using such a system, you'd expect Canopy and Aurora and Tilray all to have larger weighings than Cronos because their market caps are anywhere from 2 to 5 times higher than Cronos's market cap. However, not all indexes use straight market cap weighing. On its website, ETFMG refers to its trading index, the Prime Alternative Harvest Index, as its primary authority in making investment decisions. The prospectus makes limited reference to the actual methodology that the index follows, instead focusing on how it takes the information that the index provider gives and uses it to make its own investing decisions. What's likely to have happened is that the most recent rebalancing in December, most of the top marijuana stocks would have had roughly equal weighings because of the specific restrictions in the index methodology. Ironically, those restrictions were designed to prevent the very overweighing issues that have resulted. The huge gains for Cronos following this decision of tobacco giant Altria to invest in cannabis companies were responsible for putting the ETF's weighings out of whack. The ETF's next rebalancing is in March. The methodology should work to pull Cronos Group's weighing back down to the line with its peers. From there, relative to performance, again, could lead to over or underweighing positions within the portfolio, but it would take massive share price movements to create the same situation again. Nevertheless, for at least the next month, investors in Alternative Harvest need to understand that they're making an outsized bet on the performance of Cronos Group. If it underperforms its marijuana stock peers, then it could have a detrimental impact on how Alternative Harvest does compared to its cannabis investment universe. That's a risk that many ETF investors aren't familiar with taking, but they'll need to take it into account here. So is there a winning strategy for cannabis investing? The cannabis industry so far has been a hotbed of investment activity. There's been plenty of ups and downs in the share price of cannabis stocks over the past several years. Given how new the industry is and how much competition there is among up-and-coming players in the space, it can be daunting to decide how to invest in a way that's both prudent and yet gives you a chance at strong returns. Conservative investors often look to ways to ride the coattails of the industry insiders, and one strategy that's been surprisingly effective in 2019 is also simple: investing in the two cannabis companies that have made major deals with third-party consumer goods giants, both Canopy Growth and Cronos Group. There's been huge success, outpacing even the strong returns of the ETFMG Alternative Harvest ETF. Cannabis companies that haven't yet come up with partnerships have fallen behind their counterparts. Tilray in particular has been a notable laggard, and although a 16% gain in just a month would ordinarily be it for celebration, many shareholders wouldn't be happier if Tilray could attract a high-profile partner like Constellation or Canopy. If that were to happen, it's possible that Tilray's gains would come a lot closer to Canopy and Cronos' groups. On the other hand, penny stocks in cannabis fails to catch investor fever. There were 11 cannabis penny stock companies that hoped by changing their name would propel them into the next investment frenzy. Didn't work out. Whereas a couple years ago, all you had to do was change your name to include CBD or THC, and then your stock price would go up. I mean, just look at last week up in Canada. Weekend Unlimited changed their name from YOLO to pot, and it increased their market cap 90%. 11 Canadian penny stocks hoped a name change would propel them into the next investor frenzy. Last year, these stocks were hovering around $1. They changed their name to include cannabis in the hopes that the share price would get a lift from the pot investing craze. They weren't so lucky. Since each changed their name, the penny stock dropped on average 30% through February, and only one rose through yesterday's close. Prior to the name change, more than half of these penny stocks were involved in the precious metals business. Investors don't appear thrilled by the switch. To be honest, I'm kind of surprised that more dumb money didn't get suckered into the name change. I still feel that there's a lot of frenzy and a lot of money to be lost by bad investments, just kind of throwing money at speculation and waiting for the bubble to go up. I guess there's smart money, or people don't have as much disposable income to gamble. Not really sure which one it is, but either way, it hasn't worked out as anticipated. A lot of focus is going into CBD right now. The U.S. hemp revenues is only second to China, and New Frontier data projects a $5.7 billion hemp sales in the United States by 2020. So with the farm bill that recently passed, there's going to be a massive addition of companies either establishing or coming back from Canada, having become essentially financial refugees, leaving wherever they're from to go to Canada to file an IPO, to get access to institutional investor capital in order to become public, to get on an index, to sell as much stock as they can, to generate as much revenue as they can, and then use that to then come back into the US. Initially, for hemp, establish all of the assets and the capital requirements they need to then make that transition into THC products when the legalization happens. New Frontier Data's report on the global state of hemp 2019 industry outlook states that the global hemp industry reached $3.7 billion in retail sales last year, 2018, and an annual growth rate of 15%, driven by continued strength in the Chinese textiles, European industrials, Canadian foods, and the US hemp-derived CBD market. China led all countries with nearly $12 billion in hemp sales in 2018, followed by the United States, $10 billion, Europe, $980 million, and South and Central America, $220 million. The U.S. markets is positioned to grow under the 2018 Farm Bill with an estimated $2.6 billion projected in sales by 2022, with $13 billion in sales estimated for hemp-derived CBD products by 2022. As regulatory barriers diminish in the months and years ahead, businesses will continue to expand in ways in which hemp is utilized, especially across medicinal and industrial applications, said the New Frontier Data founder and CEO. This report is the first in-depth quantitative and fact-based analysis of the global hemp industry since the United States 2018 Farm Bill and Canada's Cannabis Act passed, two groundbreaking changes in North America that dramatically reshaped the entire hemp industry. By 2020, New Frontier Data estimates the global market will reach $5.7 billion across all markets, representing a 3-year compounded annual growth rate of 175%. The U.S. hemp industry is set to boom under the 2018 Farm Bill. American farmers have a new crop, and consumers are seeing an explosion of new and innovative products. Hemp, the ultimate triple bottom line for people, planets, and profits. Yahoo Finance had a live investor panel yesterday titled Risk-Adjusted Returns. This was at the National Cannabis Industry Association CBD. It was called Cannavest. So it was a cannabis investor panel. The moderator was Scott of Viridian Capital Advisors. Panel was fully stacked. CEO or management of a cannabis company who are investors focusing on. Checks and balances, quality assurance, future branding, basically just what your bottom line. Then they kind of dive into what cannabis sectors are you investing in. And I found it pretty funny that banking and payment solutions are a duct tape remedy and nobody's investing, not these investors at least. They also said they're not investing in cultivation. It's a race to the bottom. They're not investing in lighting, which is good. I think there's LED options, but high pressure sodium or a metal halide bulb that was used in street lighting for the 1880s, over 100 years ago, I think it's probably something you don't want to invest in. Consumer real estate, that's a bubble too. Who wants to touch that? So how will legal banking influence investor sentiment? So they're basically saying that once banking becomes legalized, how is investment going to change? And a lot of these guys didn't want banking to become legalized. They want a 3 to 5 year reprieve to be able to get more of an edge, more of an advantage. Because once legalization happens, once banking happens, and it's open to anybody. So found that kind of fascinating. But in the event that it does change and become legalized, there's going to be a shift in strategy from price driven to more of a merger and acquisition. So when someone's looking at valuations, trying to find a good value, they'll shift that strategy to just gobble up everybody. So you're going to see capitulation or consolidation. And a lot of merger and acquisitions. The most valuable key segment was data. Hands down, whatever you're doing, you need to collect data. There's a couple of interesting companies doing that. High Tunes Distribution is selling joints, and they're just focusing on CBD joints right now. But they have a QR code. You scan that, you get a free download, music, a song. But who knows what kind of data you're giving up, your contact list, full access. People just click yes, you have no idea what data you're giving away, but that's worth a lot of money. Also worth some money, another key segment that investors are looking at, genetics and branding. They're just on the cusp of looking at brands where in the past they noted that you don't have a brand if you're not selling anything. Pre-money valuation is non-existent. If you aren't making money, you have no brand. So get some data, start selling stuff. And then a question was asked, how do you project regulatory changes to interstate transportation? That fragmentation gap in the 3 to 5 year financial model was pretty interesting. They were saying that there's essentially already an established distribution channel. So once legalization happens, these investors are under the impression that that's just going to happen automatically, that they're going to know how to transport that like any other commodity. But who they're dealing with is different. I mean, how well are you going to be able to go and find tomato farmers in every single state and make that work in unison? I mean, it's incredibly complex. You're looking, these are small time farmers and they're not really business savvy. And you think you're just going to be able to come in and create a commercial distribution channel. I don't think it's going to be that simple. There was an argument within the audience and they ended up cutting off the feed because there was somebody else who said, there's state providers. Why aren't you investing in them to just flip the switch when interstate becomes legal? You have intrastate and entities in Washington and Oregon and California that can't work with each other. They're affiliated, obviously, same company even, but they just can't cross state lines. In the event that you can, the argument was that these existing transportation companies should have the investment capital so that they can scale up, whereas the investors, or at least these institutional investors, or I mean, they're not institutional, but they're limited in their knowledge too, right? They have their subject matter expertise and they're not comfortable investing outside of that. That's fine. I'm going to disagree and say that there is an opportunity because you have to know cannabis. There's CEOs out there who have never touched the product. They don't smoke. They don't know anything about THC or CBD. Long term, that's not going to happen. You can't have somebody come in and not know the product. Then you don't know the culture, and then it's just downhill. I don't care what it is. I saw it personally in banking when people were coming in from the mall. As long as you knew how to sell something, what's the difference? A mortgage or a wicker chair? There's a big difference. And now people don't really respect bankers. You don't go into a bank because you'd rather, well, actually, you could just go and talk to a barista. Capital One offers you the ability to talk about your mortgage with a barista. No. I don't really think that that's long-term. I don't think that you're gaining the respect. I don't think that you're getting quality clients. So that's my argument. Yahoo Finance reported live from the National Cannabis Industry Association conference in Boston, Massachusetts called Cannavest. There was another segment called Cannabis Market Trends and Consumer Insights. A couple of questions I found interesting that I wanted to note was, what's the investment focus for 2019 for this panel? And on the panel, you had people from Roth Capital, BDS Analytics, Canaccord, Genuity, Cohen and Company, Northland Capital. And so some of the questions that were asked is, what's the investment focus for 2019? And all of them repeated MSO. So the multi-state operators, where you see MedMen, for example, are what people are looking at. Here locally, we've got a company that had 5 stores mandated by the state. That's the cap, or was the cap for Washington State. And yet Have a Heart went out to gain $25 million in funding. They oversubscribed by $75 million. So they initially went from that Series A, or seed fund of $25 million to a Series A of $75 million. And that got oversubscribed by $75 million. So they opened up a Series B for that. So totally have 175 million, and they can now look at over a dozen different states. I think they already have with 24 more applications. So coming from local to looking at multi-state is exactly what investors are looking for, is somebody who can scale up fast. And once you're able to start applying for dozens of licenses in multiple states, you're going to start gaining the attention of these heavy hitter investors. But how are these companies making money in the cannabis industry? I don't know. You're going to have to check out my review on that. Super Chronic Josh on YouTube. That's at the 1:57 mark. The other questions and answers were asking, what do consumers want, and will the FDA get involved? Essentially, accurate dosing kind of came up as being a limiting factor and needing to be resolved. Wanted to know, how will the retail experience change with the additions of delivery? I thought that was a brilliant question, because if you have multi-state operators and everything isn't about niche or differentiation, it's about offering that experience. How do you offer that experience when people sidestep you with delivery? So then they said niche branding. I don't know. What do you think? And then what products would you recommend launching prior to FDA involvement? You're going to have to listen and find out. And with that, we're going to roll this one up. This is Talking Hedge. I'm Josh Kincaid, and I'm out.